Well, they did it, folks, and they told us that they were going to do it. They increased the overnight rate. The prime interest rate was impacted afterwards, and so we're sitting here today a 0.5% higher than we were, well, a few days before. We're going to talk a little bit more about what it all means to you, what you need to consider if you have a variable rate or a fixed rate loan, and just some of what the government came out and said today in this podcast. I mean, it's more than just the rate change. So definitely stay tuned and listen to this, because we're going to talk a little bit about everything that happens when the Bank of Canada changes interest rates and what to expect on the next rate change coming up in a month's time. As always, folks, if you're liking the episodes, make sure to rate us on iTunes and Spotify. You can on Spotify, just give us that 5 stars. Same thing on iTunes. And most importantly, share this with a friend. Last but not least, the show is presented by us at Thrive Mortgage Co. So if you want to create more real estate, let's try that again. So if you want to create more wealth in real estate, make sure to reach out to the guys who know. That's us. Just send us a message through our Instagram or find us at thrivemortgage.ca. Enjoy the show. What's up, guys? You are listening to the YVR REMO Show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. All right, they did it again. They did it again, and they said they were going to do it. This is probably one of the most easily predictable events from the Bank of Canada over the course of the last, couple years at this point right now. Raising the interest rates. What happened, what they did, why they did it, what should you do? Is the sky falling? Where is real estate going to go? Man, a lot of nervousness out there. But like I said before, I think at the end of the day, what just happened on June 1st, 2022, in terms of the rate changes, was easily the most predictable. And hopefully everybody out there was highly prepared for what just happened, which is a 0.5% increase to the overnight rate. And brought the overnight rate up a 0.5% from where it was previously. It puts us in a different position today than when we were. Almost, if you're looking at prime for most banks, it puts us about 0.2% or 0.25% below where we were pre-pandemic. So we're almost there. Guys, thoughts, feelings, emotions, any of those things?
I mean, it's just nice to see that. I've been saying this for a while. The transparency from the government in this regard when it comes to interest rates has been very helpful for us in our industry and anyone that's a homeowner to be able to budget and plan for this. They have, to their credit, and we have said this multiple times, they're doing a good job in communicating, in my opinion, around all of this, because we're also now being prepared for another increase in July, and that next increase for a variable rate customer, it's going to impact their qualification. So I know we're going to get into that later on in this episode, and the fact that, for most people, this increase today does not impact a lot of people's qualification, but the next one will, and they are preparing us for another one. So we can now start preparing, anyone that's in a situation that's buying or pre-approved that, qualification could potentially be impacted in July.
Yeah, very good points. And I mean, that this comes into play for someone that's coming up for a renewal, potentially refinancing, purchasing, getting pre-approved. So like Dean mentioned, if there's another rate bump, which there will be, we absolutely need to dig into that and make sure that numbers are still in line for qualification. But again, like what Alex said, we were all expecting this. We knew it was coming. I think that there is certainly good reason behind it. Obviously, as a consumer, no one wants to see their interest rate go up and no one wants to pay more. But when you look at what's happening in our country in regards to inflation, it is out of control. Like, we're looking at almost a 7% inflation rate. And for anyone that doesn't really understand that, if you have money sitting in a bank account, not invested, earning zero interest, you're actually losing money day over day, because everything else in the world is increasing by 7% and your money's staying at zero, right? So now when it comes to investing and trying to hedge your money, we have to compete with a 7% inflation rate, which is tough. It is not easy to turn a 7% rate on investments. Obviously, real estate's been a massive tool for a lot of people, but that is something to consider. And the goal of where they're trying to bring inflation down is to 2%. Like, that's a massive decrease. And one of the biggest tools that our government has is really raising rates to slow things down.
Yeah, I mean, it's the only tool. And we've talked about this too at length. It is the only tool to combat inflation. And to your point, the target's 2%, and we're exceeding 7% right now. So, based on the Bank of Canada's messaging today, they want to continue to raise rates to get it to their target, to what they call, smothering inflation by these increases. And that's leads to another point. Like, we're looking at, we now just experienced 2 0.5% increases. First time since 2000, I think, since that occurred. And that's their measure to what they call smothering inflation. We'll see if it works. I mean, we've read lots of articles. I mean, we're quite the nerds when it comes to this type of stuff, but as we should be and as we have to be, it doesn't seem like it's actually going to work, which is a concern for me. And I know, Alex, you mentioned this off air.
Derek, you did a good job with the whole concept of inflation there, but let's kind of circle back a little bit here and talk about what you mentioned there, Dean, in regards to this being the only tool that the bank has that can potentially impact or cool inflation. So interesting thing, I've been obviously thinking about this for weeks and months, and just more specifically, just basically reading through this announcement. First of all, transparency. They told us they were going to do it, and they did it. And they came back after this announcement and they said, okay, well, we're probably going to raise rates again. And what does that look like? We don't know, but they've told us where they're trying to go. So you mentioned an inflation target or a percentage. They're trying to get to 2 to 3% on the overnight rate. Today we sit at, I believe, what are we at? 1.25 quarter or 1 3/4 today? I got to get my 1.5. Thank you. We're at 1.5 today. So that gives us a 0.5% change to get to the lower bound of what they projected to get to. So, I mean, a few things to consider when we look at those numbers. First and foremost, when they say we're trying to get to 2 or we're trying to get to 3, obviously that's a goal. It doesn't mean that we're going to get there. It doesn't mean that we couldn't go beyond that. It's just more of a target. Looking at just from a broad perspective, again, going back to pre-pandemic versus now, pre-pandemic, we were 1/4% above where we were at today. So if we're going automatically up a 0.5%, we're going beyond the pre-pandemic levels. That's a big thing to consider. The second thing, which is a completely different topic, is looking at the fact that a lot of the issues that are going on in the country right now, or a lot of the issues that are going on in terms of price points and so forth, are unrelated to Canadians or Canada as a whole. Like the war in Russia and Ukraine is causing certain issues, globally speaking. What's happening in regards to supply chains continues to be an issue still because of what's happening in China with continued COVID lockdowns, putting more pressure. And so, even though we're seeing an uptick in jobs and we're seeing a lot of that going on, I'm, a little bit nervous to suggest that continuing to go up at that dramatic of a rate will have the proposed impact that they're looking for, and I'm a little bit concerned that the bank will raise rates a little bit too much and put us back into I don't know if a recession is the right word, but into some form of a mini recession if they can continue to go up in that way.
Yeah, I mean, the fear is it's a global recession is the fear right now, and it does seem pretty imminent at this point based on what's going on. And to your point, China, I mean, COVID lockdowns. Think of how much stuff comes from China that you use in your daily life. So, I mean, as a country, as every country is trying to do right now, is they're scratching and scrambling to produce more of their own resources at home. Whether it's the t-shirt you're wearing on your back or the spoon you're using to eat your take home lunch or whatever you're using for plastic materials. I mean, we got to find a way to create things at home. That's obviously a focus. And first and foremost, we got to find a way to get more fuel out of our ground. I mean, Canada's got some of the most natural resources in the world when it comes to, fuel. We have to find a way to pull more out of the ground and not rely on other parts of the world for fuel resources. And I know that the Americans are well ahead of that now, and they've somewhat fixed their inflation issue to a degree. I mean, they've definitely started to see it decline, and we're always seem to be 6 months behind that market when it comes to our country, and I don't know, whatever we do, it seems like we follow them almost step by step in that 6-month timeline, and they have started to see their inflation start to decline slightly, which is good because, like, even if it's just a couple decimal points, it's positive because we're only been going in the up direction lately.
Yeah, to your point, like talking about the U.S. as a whole, I know we're going a bit deeper. We haven't even talked about recommendations or what people should do, so we should probably get into that. But I mean, it's a good conversation to have, and we do, as you mentioned, echo a lot of what happens in the United States. And for those paying attention, the U.S. has their version of the Bank of Canada's rate change, which is called the Fed, and they went up real quick there, back between, I want to say, what was it, about February, maybe March? I'd have to go back and look at the dates. March to April, and so they had a little bit of an early run, and they went a lot quicker than the Bank of Canada did. In any case, to your point, you're exactly right. Inflation numbers since the highs reported in March of 2022, they're back down from 8.5 to 8.3 to 8.1, which brings us back to basically January levels, and the things are looking like they're getting under control. So I guess my thought process is that the Canadian government obviously is looking to do something very similar to that. My fear is that they go up a little bit too fast and they don't let the leg come, so to speak, and let things work themselves out like they should at this point right now. Any thoughts on that, Derek?
Yeah, I mean, I think you're right. I don't have too much more to add to that piece, but I think you hit the nail on the head.
That is their intention, right? Their intention is to raise it too quickly or too aggressively. That's 100% their intention. When they say smothering inflation, that's what they're doing, right? So there will be that lag based on what they're saying to us and what they're showing in action with 2 half-point increases. That's exactly what's happening, and that's what we need to prepare for, and they're preparing us for that. So we can disagree, is it the right decision? Disagree or agree if this is the right decision, but at the end of the day, it is what they're doing. They told us it's what they're doing, so let's prepare for it, and that's ultimately what we've been doing for the better part of the last 3 months.
Agreed. All right, well, let's talk about what the impact is on borrowers and the real estate market and what's going on there. I mean, Derek, why don't you start off by talking about the breakdown? What is the impact and who does it impact?
Yeah, one thing that's different this rate hike compared to the last couple is it's taken the last couple of rate hikes that we've had, the banks have kind of delayed for a month. They wait till the end of the month to actually adjust their prime rate. We had an announcement at 7:30 this morning, and we've gotten emails from pretty well every single bank that we work with saying that as of midnight tonight, their prime rate has increased, or it already has increased. It's changed. So last time around, if you were in a variable, adjustable, any type of a variable product, you wouldn't have actually seen any impact for a little while. Now it's immediate. It is happening as of tomorrow. Whether your payment changes or not, that depends on the lender and the product that you're in and with. So it's funny, we get a lot of calls saying, hey, I heard rates are going up on June 1st. I want to lock in. I want to rush my mortgage application. I want to lock in. That doesn't actually matter, right? If you're getting locked into a variable, we're locking you in at a discount, and it doesn't matter. The rate increase happened today. Your rate's going up as well. That's how it works. So rushing to lock in your rate today, there's not a lot of point in that. Fixed rates are also not directly correlated to Bank of Canada rate increases, right? So we've talked about this before, but over the course of the last 12 to 18 months, we've seen rates go from 1.79% to 4.79%. But no one talks about that because it's kind of behind the scenes, right? It's the banks doing those as the bond yield changes. So today, again, just to reiterate, if you're in a fixed rate mortgage, you do not have a direct impact on this. You have your fixed rate guaranteed until the end of your term. If you are coming up for renewal in the next 6, 12, 18 months, I would suggest a conversation with us now, because we don't know where we're going to be at that point. It might make sense to get out early. Your penalties could be a lot lower than you expect because of how high rates are. It's all kind of up in the air. So who is impacted? Variable rate mortgage holders. That's who's impacted. Your rate's going up no matter what. And again, to circle back with what I said a minute ago, whether your payment changes or not, hopefully you're aware of what type of product that you're in. Some lenders offer static payment and some have fluctuating payments. So what that means is if you're in a static payment, even though rates went up, your payment doesn't change. The amount of interest and principal that you're paying inside of that set payment is adjusting. You're going to start paying more interest to the bank and less of your principal. And if that continued for the rest of your term, technically you would owe more on your mortgage balance than you should. And that needs to be readjusted at maturity. So that's kind of who's been impacted and why. Alex, maybe you want to dig into the dollars?
Yeah, let's get into it. So basically, if you are in an ARM or an adjustable rate, we like to call it an adjustable payment mortgage, which most lenders actually offer these days is adjustable payment mortgages. Your monthly payment is going to increase by about $24 per $100,000 of carried money. So again, if you put that in context, let's just say 25 to make it nice and sweet and simple. If you're borrowing $500,000, it's about $125 difference. If it's biweekly payments you're making, just cut that in half. Essentially, it's like 60, 65 bucks that you're looking at increasing your monthly payment. So for most people, that's not a huge impact. Obviously, there are some larger loans out there. If it's $1 million loan, double those numbers. If it's half that, cut the numbers in half. It really depends on your personal situation. But what I've learned in my experience, first and foremost, a lot of these folks that have these loans are in a position where they are overqualified. Like again, we qualified at 5.25, but maybe they got a mortgage at 2% or 2.5%, right? So it might be a shock to your system initially speaking, but first of all, I'd recommend, setting your budget. And we talk to this every single client. We recommend over budgeting and adjusting with their numbers, no matter what situation you're in right now. My biggest piece of feedback right away for those folks is just be prepared, look at your budget, have a quick peek and see if it's actually going to have an immediate impact so it doesn't surprise you. And of course, consider, if that's a concern for you, consider some other options. Although no matter what option you choose, in many circumstances, there could be an additional associated cost, with the exception of perhaps the variable rate mortgage, which, Dean, or Derek, I just want to circle back to you before hopping over to Dean, but you had mentioned a phone call that you had earlier today with a lady that was considering her options, and can you just maybe share that story and talk a little bit about what came of that?
Yeah, so this client had called me and she was curious about locking in. She had just finished a phone call with her broker that set up the mortgage recently, and he was suggesting that she go fix. That was his recommendation. He called her to make that comment because of predictions of rates going to X. She obviously wanted to get a second opinion, so we kind of talked through that. And we talked about where rates are and the jump. She was going to be jumping from about a 2.7 into about a 4.7 rate if she made that conversion with her lender. Because she was so new into her term, she only had the ability to convert into a 5-year fixed, right? So immediately her concern is I'm jumping into an inflated rate for a very long time and rates are likely to come down in probably 2 to 3 years. It's up in the air, but that's obviously a concern. So we talked through that, and most people right now, if you're going to convert, ideally you want to get into a 2 or 3 year with a goal of hoping that rates are down to a more normalized level when you're up for renewal. She didn't have that option without breaking her mortgage, so we talked about what that might look like, maybe transitioning to a different lender. I just want to say, for anyone thinking about converting, you're not stuck with your lender. You don't have to stay with your bank. If there's a better option somewhere else, if you want to get into a shorter term, you can absolutely do that. Keep in mind, you're in a variable, so your penalty is 3 months of interest, relatively low cost, right? If it's going to get you into the product that you actually want to be in. And then we talked about a different type of variable. So she's with a bank where the payments do fluctuate, and that's their fear, right? Their fear is looking at numbers if rates go 3% higher, dramatic, but if that happened, it would be unaffordable for them. So we talked about getting into a static payment variable mortgage. Her rate would end up a little bit higher than it is right now. So she is giving up a piece of that off the bat, but she's in a variable product, which the whole family likes. That's why they went variable. But it kind of takes that fear of fluctuating payments out of it. So it was a good conversation. It kind of opened her eyes to some different options. And I think that this is what everyone needs to do, right? Because everyone has these questions. Everyone's thinking, what is the right decision? And I'll tell you right now, I don't think anyone actually knows. But you got to think about strategy. You got to think about your personal risk tolerance. You got to think about budgeting, right? And you got to go with your gut after you have an educated conversation with someone like us.
One thing I've had a lot of question about lately is anyone that is in a static payment is starting to think of the trigger rate and ultimately what's going to happen then and when that occurs. And that's something we don't have to do a super deep dive into now, but it is a valid concern. And essentially what that means is that, depending on your lender and your term, you could reach a point where your rate gets high enough where the bank ultimately wants to make a lump sum payment to bring the principal back down to where, close to where it should be. Because at some point, if the rates continue to go up, you could get to a point where potentially you're not paying as much principal down as you should, and you could get to the end of your term and have a lot more years left than you would have originally expected. And so that's a valid fear for a lot of people. I think in our market here, especially, and you could argue Ontario, parts of Ontario would be the same. Is, I don't really have much fear in that. I'm currently a static payment customer myself, and I look at it this way: as I have a lot of equity in my home due to recent appreciation. And, if you're somebody that, purchased your home in the last 18 months, you probably gained a lot of appreciation in your home. And to fear that, potentially your principal isn't going down at the pace that you would have expected originally, there is a lot of appreciation in that home. And there could potentially be, a really easy solution to just refinance at that point in time and ultimately fix that situation if you do get there. So I think there's a lot of peace of mind in the fact that where we live, where we invest in real estate, we're in one of the best markets in the world. And I personally don't think that's much of a fear. And I found a lot of my clients would agree with that.
Yeah, well played. There's a lot there that you said there, and everything from obviously the variable rate loan and the trigger rate, some suggestions there. I mean, Derek obviously touching pretty heavily on getting a second opinion and all this. I think it really just says to me, like, more than anything else, just from an opinion factor, being in this all day long and the conversations we have, more now than ever, like an active management approach and a continued conversation, just remembering that these things are fluid is super important. Like, I mean, I was just pulled up an article while we were chatting right here, and it just shows you how different the opinions are. Because on one side, I got someone saying, hey, we're going like Derek, that experience your lady had, so they're going to go to 6%. And on the other side, it's like, hey, the only thing that they're going to hurt here is housing. And so eventually they're going to realize that and they're going to have to pull back a little bit. So, all these points are valid on all sides. But I think what you mentioned, Dean, there, which is super important, is consider your budget, consider stress testing yourself, consider looking at making those prepayments to ensure you're not in a negative position. But I would like to take just a minute or two as we kind of close out this part of the topic to talk a little bit about real estate as an investment and what you guys see going on here over the next little bit. We were talking a bit about Alberta. Dean, you touched on BC and Alberta, but man, it still seems like there's money out there. It's still flying out. We're seeing more accepted offers. Heck, I've seen more accepted offers hit my desk in the last 2 weeks than the last 2 months. So, I still see the consumer confidence there. What do you guys think is going to happen here?
Well, I think it's super important to keep in mind. I know many investors that lost a lot of money in 2008 when things did turn, and the reason I found a lot of people lost money back in those times is if the market does turn and does go downward, especially for people that did buy in the last, say, 6 months at what we would call the peak. Fire selling and taking a loss, that would be highly recommended to avoid that situation. And the number one thing I hear from anyone that, is potentially looking at fire selling because they think that their home is going down in value and they want to get out before it goes down even further, my advice would be to know I'd actually ride that out for at least a 5 to 10 year period of time, but at a minimum 5 years. And I think just, I know your kind of intention here was to kind of get into opportunities and whatnot, but I think it's also important to keep in mind that, the people that have real estate right now and did buy in this 6 months, they need to be confident in that. And this isn't a short-term investment. This is not a short-term investment. This is a long-term investment, and you need to weather this. This will be short-lived, and I do believe that. So if we do see a bit of a bump downward, I guess you could say, in evaluations, and yes, that's going to bring opportunity. That is going to be a great opportunity for anyone that's sitting on the sideline looking to buy. But the ones that are fear that they're going to lose, like, stay with it, stick with your home and ride it out.
Yeah, it's a good point. And I mean, from my side, honestly, what I've seen, because if you rewind and think about where we were at for the last literally 2 years for buyers, it was like you can't even get a house. People that couldn't go subject free were not getting offers accepted. They couldn't afford it. They got priced out. So what I've actually seen and what we've really been kind of pushing to our clients is you just watch the market go up by 40%. Obviously, you're exhausted, you're beat, you feel like you're never going to be able to buy. Like, now is your actual opportunity to buy. You can get an offer accepted with subjects for like a week or a week and a half, which is more than the 3 days we were dealing with before. You're able to buy a condo that's listed for $400,000 for $395,000. Like, you don't have to offer $500,000 anymore. So although rates have gone from 2 to 4, you're able to get a property for like $100,000 less. Detached homes, like houses that were selling for $1.75 million, you can actually pick them up for $1.5 million right now, right? And like we talked with Ty Corsi last week about this. I don't think those houses were necessarily worth $1.75, but that's what people were forced to pay to get their offer accepted. So like you're still paying market value, but there's a huge discount because of that. So who cares if your rate's higher? Rates will come back down, right? You're getting a massive discount on property. So we've just seen a ton of people that went through the weeds of the really tough market, and they're actually pulling the trigger right now because they're realizing what's going on, right? I think new people who are coming to the market right now are a little bit more hesitant because there's lots of talks of market going down and rates going up. But everyone that saw what we just dealt with for 2 years is there's a little bit more common sense there, I find.
The market we just went through, like that was not fun for anyone involved. Anyone in the transaction, that was not a good experience, especially when you're having to go subject free, over asking. This is a great time to buy from just a sense of this is great peace of mind. Like, as a buyer, you're actually probably going to really enjoy the experience because you are going to get some, the adequate amount of time to assess the property, do your due diligence on the property, make sure it's the right home for you, whether it's a home inspection, subject to financing, all those sorts of things. Not even aside, like to Derek's point, and I'm sure you're going to touch on this, Alex, is just from like getting a deal or saving money and not having to pay full ask. Like for me, it's just the peace of mind that we actually have the time that we need to make the right decision, and the subject free stuff is not really even there anymore. And that to me is a huge win, just that alone. And so if you're a first time home buyer, you don't have to sell a property to buy. Great time to buy. Like, oh my gosh, I would love to be a first time home buyer right now versus 6 months ago. And same thing if you're a homeowner that's looking to buy a rental property. Again, you don't need to sell to buy something right now. You're gonna just have a great experience overall.
Agreed, man. Agreed on all accounts. Well, I don't think we have time to get into, because we meant to make this short and sweet to the point. I don't know if we have time to get into the whole Calgary, Alberta, and what's happening in the different markets right now, but we'll save that for the next one. Let's just put it this way. I agree on all accounts with you in regards to the opportunities, and that explains why, like I said, in the last 2 weeks, at least my personal experience, there's been more coming in the door than the last 2 months, which has been crazy to keep up with. Actually, there's one last note I want to leave this on. A lot of people don't realize this, and if you're looking to get a mortgage, the one thing to make clear, and something that I'm seeing, and we'll do a full episode this, is lender appetite for large loans or exceptions. They're not only are they slower and busy right now, busy obviously because of accepted offers, but I'm also noticing the appetite for certain loans start to go away, whether it be investments, but mostly exceptions. So I'm going to leave that little nugget there. We're not going to get too deep into that, but I think that's going to be a topic for one of the next episodes, and how lenders change their guidelines in changing markets and how that impacts you as a borrower.